Hello, I'm Mary Reed, National Director of Qualified Plan Marketing for Alliance Benefit Group Pentegra. We are a third-party administrator of qualified plans and currently administer about 3,500 plans. Our parent company, Pentegra Services, Inc., has been in the pension business for nearly 70 years. Together, our expertise and talented staff helps find solutions for clients. Welcome to our training series for financial professionals. In this series, we will use our expertise to help prepare you to find prospects and write qualified plans from closing to establishing the plan and further administration. Let's begin. Welcome to our session on Section 79 plans. Section 79 is something you may not be familiar with, but has been around for a long time and is often used in conjunction with a qualified plan, either layered on top or sometimes as an alternative too if the qualified plan just can't work out well enough for that employer. So what is a Section 79? Section 79 is a section of the Internal Revenue Code that provides for offering group term insurance to employees, typically known as the $50,000 group term insurance that employees are given. It's a plan that that does include the $50,000 term, but can also provide permanent benefits in the terms of permanent insurance. That's not used very often, but it is allowable under the regulations, and there are a couple of companies that offer such programs. You need a specially designed product to make this concept work. You need a policy that's specifically designed for Section 79. Those are not available everywhere. There are only 2 companies that I know of that do that, but they do it very well, and it can be a very nice arrangement for some employers. This plan will be 100% life insurance. It's purely a life insurance program. So what makes the plan advantageous? Well, all the premiums that are paid by the corporation will be deductible to the corporation, whether it's for the $50,000 term or for permanent insurance for the participants. Now, keep in mind that you do need a C corporation for this to work, but they will all the premiums will be deductible on that corporation's tax return. Typically, there'll be 3 offerings out to the employees. There'll be the $50,000 term insurance, and that is free to all the participants. But you will also offer 2 other scenarios which would offer more than $50,000 in coverage, one being term, one being permanent. We'll look at that later on. But if the participant, if the employee chooses to take the offering with the more insurance, the amount of insurance above $50,000, there will be a reportable value that's reported out and added to their W-2, and that value is defined by IRS Table 1 pursuant to the regulations. So, and as I said, only specifically designed products are really going to work here. You cannot just take an off-the-shelf product and put it into a Section 79 and get the benefit. So let's look at why an employer would do a Section 79. As I said, it's deductible, so lots of times these are layered on top of qualified plans to get a greater deduction. They've maxed out the qualified plan and are looking for something more. They can also work for larger groups where the qualified plan at some point either it may not work at all, or at some point it just may not be efficient because too many of the dollars are going to the rank and file employees and too few to the people that the business owner wants to favor. In that case, this may replace a qualified plan, or you may have a qualified plan that's not taken to the max, but just to that efficiency level, and then this is layered on top. Another reason for Section 79 is it will produce future tax-free income. So it's great tax diversification. You've got the qualified plan 100% deductible on the front end, 100% taxable when you draw it out at the tail end. Here, deductible, 100% deductible, but partially reportable, so you get some tax leveraging up front, but the income that's drawn at the tail end will be income tax free. So you get that nice balance. It gives the covered person a lot of diversification, and they can adjust their distributions and planning as they need to, both on the front end and the back end. And then there's just the simple needs. Sometimes people just need life insurance for any personal reason. It could be for personal protection, family protection. It could be for estate planning. There are a number of reasons, and this is just a cheaper way to buy it. So let's look at it from the business owner's point of view. What benefits are there for the business owner? Well, first of all, they get a death benefit. It's probably driven by their need and their desire to get that death benefit, to buy the life insurance, either for family survivor needs or perhaps for estate tax planning strategies. You get tax benefits. The corporation gets the deduction. So that's a good thing. And if I own the corporation, I'm getting 100% deduction for all the premiums paid in my corporate return. Yes, there'll be a reportable out on my personal return, but it's only going to be about 60 or 65% of the premium, so I get that nice spread and leveraging. It's also a very attractive employee benefit to help attract and retain employees. And that certainly has a value. And then, as I already said, the policy, because these are individually owned policies, will produce cash value that business owner can draw upon for retirement when they're ready. Now, for the employee, there's also benefits. The employee benefits from a nice life insurance benefit that's fully paid by the employer, thereby providing survivorship needs for their family. Tax benefits for them. If they took the 50,000 term, they're getting the insurance for free. Again, it's a personal policy, so even if they choose the permanent coverage, they'll have that cash value in that policy later on accumulated for them that they can pull down for income in retirement. And again, if they take the permanent policy, it's completely portable. They own it. They name the beneficiary. They leave the company. They take it with it. It's completely their own. So who is an ideal prospect? If we look on slide 9, we've tried to outline here. First of all, ideal prospect, someone who owns a C corporation. Preferably a relatively small C corporation. Could be 200 lives, could be 50 lives, could be 20, could be 10. A non-owner key employee of a business entity, someone who may be interested because this would help them, and they would provide access into the business to talk about maybe the business adopting a Section 79 plan. Primarily focused, it's best for people who are ages 35 to 55. Most likely they're insurable at that age range, and they have enough time to let that policy accumulate cash before they're going to draw on it for retirement. Typically, the individuals who do this have income that exceeds $200,000. They have a need for life insurance. They have a desire for their life insurance, and they're motivated by the income tax advantages. As I said, maybe they've maxed out their qualified plan, or maybe the qualified plan just didn't work for their group. And they have to be willing to commit to a significant amount of annual premium for 5 years. The policy that's typically used here is a 5-pay policy. It will be paid up in 5 years, and then they're done, but they have to pay for those 5 years. Why do you need a C corporation? The reason you need a C corporation is that Section 79 is only allowed to provide insurance that's meant for employees. And so the following are not considered employees. If I'm a self-employed individual or a partner in a partnership, not considered an employee. Greater than a 2% owner of an S corporation is not considered an employee. They're considered owners. And so to be an owner, you must have W-2 income from a C corporation, and that's why we need a C corporation. I can tell you it's not uncommon in these organizations. We get smaller organizations, they may be S corporations in particular, interested in doing a Section 79, they will create a C corporation. That's between them and their CPA, whether they feel that that's appropriate or not, but that is certainly a possibility. So let's take a look at how a plan actually works. I'm on slide 11 here. Typically 3 options are offered to all the eligible employees, and there will be eligibility requirements, but 3 options are offered. The first one, you can have permanent insurance. It will be some multiple times your compensation, and that multiple usually will be determined by how much permanent insurance the owner wants. Whatever multiple it is of their compensation, that's the multiple that will be available to everybody. Or you could take that same multiple of compensation, but take it as term insurance instead. Or you could just choose to take the 50,000 group term. And how would you choose one over the other? Well, it depends on cost. If you choose option 1, and you can see this on slide 12, if you choose option 1, which is the large amount of permanent insurance, you're going to be, as an employee, will have added that value added onto your W-2, and it could be a significant amount of dollars that you'll have to pay tax on. If you chose option 2, which is the greater amount of insurance, but all term, an amount will be added to your W-2, but it won't be as great an amount. Or, of course, if you take the 50,000 term, that is absolutely free, and there's no cost to the employee whatsoever. So to kind of summarize here are our options. Option 1, I'm going to reverse the order now, because this is how people actually think about it, is the 50,000 group term death benefit. Premiums are all paid and deductible to the employer, no tax on income to the employee. Option 2, group term death benefit, more than 50,000, some multiple of salary. The premium is 100% deductible to the employer, but the employee is taxed on the table 1 value of that insurance. Option 3 is the cash value life insurance, Premiums 100% deductible to the employer. But the premiums is partially includable in the employee's income. Typically, about 35 to 40% of the premium will be excluded from taxable income. The balance will be reported out at the taxable at the Table 1 rates. And again, you need a specific kind of policy designed to do this. Here's a sample case to give you an idea of what it might look like on slide 14. Here we have an owner and 5 employees. Now you can see the owner who's going to be driving this idea, they're not going to even be looking at it if they're not interested, so they're probably interested for themselves. You can see here if they take the option 3, which is the permanent insurance, they will get they could get a death benefit here of $2.2 million, $2,232,515. The premium is $100,000. So that $100,000 would be paid by the corporation, and the corporation would get the deduction for that. What's reportable out on their W-2, based upon the valuation of the policy in the Table 1, is $62,298. So you see they're getting the leverage of getting the benefit of a $100,000 premium here, but it's only being valued and added to their income at the rate of $62,298. So they get that spread there of about $38,000 in their favor. And they have that $2.2 million death benefit. This is a permanent policy. It's in their name. It belongs to them. The corporation will pay that $100,000 premium for 5 years. The policy will be entirely paid up and done. And that owner can go forward from there. Now the employees could choose any of the options, but let's take a look at, let's just start with employee 1. If they took that larger amount of insurance, they could get $478,500 of coverage, but they would have $12,754 added to their taxable income. That could be quite a lot of money for someone who wasn't looking for insurance to begin with. Now if they took it as option 2, they would get the same amount of death benefit, but only have $771 added to their income. Or they could choose the $50,000 free term and nothing would be added to their income. The premium that the employer would pay for that would be $177. So typically in these scenarios, what the owner wants to have happen is the owner wants to take the permanent insurance and is probably hoping that all their employees take the $50,000 free term. In this case, if they did that, the premium paid by the corporation and deductible would be the owner's $100,000 plus the total for everybody else. So it would come down $100,595. That would all be deductible to the corporation, and the reportable taxable income for the owner would only be $62,298. They would pay tax on that amount. Depending on their tax rate. That's a pretty inexpensive way to buy $2.2 million of insurance. If the employer is not sure what the employees might do, sometimes they'll take a kind of a survey first and see what the employees sound like they might be choosing. Experience has told us, the people I know who've done these plans for years, that 99.9% of the time the employees take the free $50,000 term. I would say there might be exceptions to that rule if you're doing companies with a high group of professionals, let's say architects, those kinds of things, who might be willing to pay the tax on that additional income to get the permanent coverage. But most of the time the employees are taking the $50,000 term. All right, so how do you write a plan? You have to have, this is different than writing a qualified plan in that you need to work closely with a qualified plan administrator who does Section 79. Now, the services that provided by that TPA are different than for a qualified plan, because when you're selling a Section 79, the TPA is directly involved in the sales process. The reason for that is a lot of work has to be done to put the proposal together. It's not just running design numbers, not that that's so easy, but the proposal has to include the insurance, proposals, the illustrations, the $50,000 free term, a group term policy, has to include the additional term as the option. So there's a lot of insurance quoting that has to be pulled together and built into the proposal, as well as making sure that all the eligible employees are being represented, nothing discriminatory is happening, those kind of things. There are 2 companies I know who do Section 79 plans. That would be Pacific Life. They work with one specific TPA that they require, and National Life Insurance Company. They're writing it through Life of the Southwest, one of their subsidiaries. They have 4 TPAs that they designate to work with. You can choose among the four. Any of the four is going to do the same thing. They're going to do all these things. They're going to do the sales support, the proposal, they'll do all the paperwork to establish the plan, they'll do the ongoing administration, they calculate the annual income exclusion, the amount that has to be added to the W-2. Any of the TPAs do that. ABG Pentegra works very closely with the Business Planning Group, who is one of National Life's designated TPAs, to provide those services. So let me just tell you a little bit about Business Planning Group. They're very experienced in this. They are among the largest and longest serving third-party administrators for Section 79 permanent benefit life insurance plans in the country. They began in 1993, and they have more than 4,000 plans under administration, including 800 of which have permanent life insurance policies included in them. Those policies represent an average of $12 million of annual life insurance premium. So you can see Business Planning Group is a very well-established TPA in the Section 79 arena, and that is why we have chosen them as an alliance to work with, so that we can help you better service your clients. And the way we work with Business Planning Group is if you come to us with a qualified plan prospect, or you came to us with a Section 79, same thing, or if you went to Business Planning Group, say with a Section 79, we will both work together to look at both options for that employer. You don't have to run back and forth. We will look at both our options, discuss them with you to find what is the best solution for that employer, whether it's one of the plans, a qualified plan, a Section 79, or a combination of the two. We will help you figure that out and help you put the pieces together. Once someone is on board and they want to move forward, how do you actually write the plan? You've identified the prospect. You would then contact either us directly or your Business Planning Group, or if you're using another TPA, you can certainly do that. But at whoever you're using, your next step is to contact the TPA to start putting that plan together. They will work with you to identify all the eligible employees, figure out what the options will be, put together the proposal, get the group insurance quotes, all that put together for presentation to the employer. And if the employer wants to move forward, to work through the process of getting life insurance applications completed, the employee elections, and all those factors. They will also create the plan documents to get them signed to establish the plan. Then once it's set up, the corporation will make the contributions going forward. Policies will all be issued to the participants, and the TPA each year will do all the discrimination testing, reporting, and calculate that annual income exclusion. So what could go wrong here? There are some things, just like any plan, that could go wrong. If the employer is unable to fully fund the plan for 5 years, they could get into a very difficult situation with the policies. The policy performance could fall short of projections. At National Life, they're using an indexed UL product. They're using a fixed rate for the first 5 years, but you never know. If policy performance should fall short, that could leave a shortage. And you have to be careful here. You don't really want to reduce the face amount within the first 7 years, because that could create a MEC, which is not something you want to do for the policy. Another thing that could go, non-discrimination rules could be violated by mistake or by intent. Rank and file employees could choose the costly options and really put the employer in a difficult situation where they may have difficulty affording the premiums. Of course, they can always cancel the plan and back out or not implement it if that's the case. And of course, IRS or Congress could always change the rules. They could always do that to us in any tax-advantaged arena. But this has been around for quite a while, and we think that Congress has their hands full doing other things for the meantime, so we don't expect any changes soon. So that's kind of the quick lesson on Section 79. If you'd like to learn more, Business Planning Group runs training WebExes on an ongoing basis on Section 79. We could also help you and answer some questions. So if you'd like access to any of that information, just give us a call or send us an email. We'll be happy to help you. Thank you. Thanks for attending this webinar. If you'd like additional information, please visit our website at abgpentegra.com. You can also reach me via email at mread, that's R-E-A-D, like you read a book, at abgpentegra.com, or you can call me at 802-477-2018. Thank you.